Let me show you a number that changed everything I thought I knew about investing. That's it, just a number. The 10-year U.S. Treasury yield as of right now, early 2026, 4.4%. Most of you looked at that and thought, okay. And some of you are already reaching for your phone to open TikTok because what does a government bond have to do with anything? Here's what it has to do with everything. That single number, 4.4%, right now, is the reason your mortgage rate is what it is. It's the reason your 401k didn't grow as fast as you expected last year. It's the reason your employer's stock options are worth less than projected. It's the reason your rent went up because your landlord's financing costs went up. It's the reason the startup your cousin works for quietly did layoffs in January. And here's the part that should really bother you. You probably checked your stock app this morning. You might even have a watch list. You probably know whether the S&P was up or down last week. But I'd be willing to bet real money that you have no idea what the 10-year Treasury yield did this month. That gap between what you're watching and what's actually moving your financial life, that is what this video is about. The electrical grid. I want you to think about electricity, not in a complicated way, just this. Right now, in your home, there is electricity running through the walls. You don't think about it, you don't watch it, you probably don't know what voltage is running through your outlets right now, but it is there, powering literally everything you're doing. The moment the voltage changes, the moment there's a surge or a drop, everything plugged in responds immediately. Your computer dims, your refrigerator's compressor strains, your lights flicker. The bond market is the electrical grid of the financial system. Every asset class you actually care about, your index funds, your real estate investments, your tech stocks, your employer's ability to offer you a raise, all of it is plugged in. All of it is drawing power from the same source, and the voltage running through that grid is called the yield. When yield goes up, everything plugged in gets stressed. When yield falls, everything plugged in gets a boost. And just like electricity, you don't have to understand the physics to get burned when the voltage spikes. You just have to be plugged in, which you are. Here's the number that should reframe how you see this. The global bond market is now estimated at roughly $143 trillion. Let me put that in perspective, because billions and trillions start to blur together. The US stock market, the thing almost every retail investor focuses on almost exclusively, is roughly $50 to $58 trillion. So the bond market is nearly 3 times larger than the stock market. It is not a niche asset class. It is not something for retirees and insurance companies. It is the largest financial market on earth, and it sets the price of money itself. And yet, and this is the part I find genuinely incredible, the average retail investor tracks it approximately never. Think about what that means. You're making decisions about your retirement timeline, your home purchase, your stock allocation, all while ignoring the single largest force acting on every one of those decisions. It would be like trying to manage your electricity bills without ever looking at the power grid. You'd just be confused every month when the bill didn't match your expectations, blaming the wrong things, adjusting the wrong dials. Let me give you the real explanation of what a bond is, because the textbook version is technically accurate and completely useless for how bonds actually affect. Here's the textbook version. A bond is a debt instrument where an issuer, a government, a corporation, a municipality, borrows money from investors and promises to pay a fixed interest rate over a set period, then return the principal at maturity. Fine, true, helpful to approximately no one. Here's the real explanation. A bond is a contract about the future price money. When you buy a bond, you're locking in an agreement about what a dollar is worth over time. The yield on that bond doesn't just represent your personal return, it represents what the entire market collectively believes money should cost right now and in the future. Multiply that across trillions of dollars of bonds outstanding, and you have a continuous, real-time vote by the most sophisticated, best-resourced investors in the world on the current and future price of capital. That vote moves your mortgage rate. That vote moves your car loan rate. That vote determines whether companies can afford to borrow cheaply to hire more people or whether they need to cut costs. That vote is happening every single day in a market you probably don't watch at all. Now, here's where the textbook explanation actively hurts people. Most of us were taught, if we were taught anything about bonds at all, that bonds are conservative, boring, and move in the opposite direction from stock. Old school portfolio theory says put 60% in stocks for growth, 40% in bonds for stability, rebalance periodically, and you're set. That framework is not wrong exactly, but it treats bonds purely as an investment product in your portfolio. It does not, and this is the critical failure, it does not explain bonds as a pricing mechanism that affects every other investment you hold and every financial decision you make. Here's the distinction that matters. You don't have to own a single bond for bond yields to dictate your financial outcomes. Read that again, because this is the thing most retail investors have never internalized. The yield on the 10-year U.S. Treasury note is, right now, the baseline return that every serious investor in the world uses to evaluate every other investment opportunity. It's called the risk-free rate. Not because there's literally zero risk. Technically, there's some inflation risk, some political risk in the extreme, but because, for all practical purposes, the U.S. government has never defaulted on its debt, and lending money to the U.S. government is the closest thing to a guaranteed return that exists in global finance. So, here's how it works in practice. In early 2026, the 10-year yield is around 4.4%. That means any institutional investor, pension fund, endowment, sovereign wealth fund, hedge fund, can park capital in treasuries and earn 4.4% annually with almost no chance of losing money. Now ask yourself, why would that same investor put money into stocks, which carry genuine company-level risk, sector risk, management risk, regulatory risk? Why would they accept all that added uncertainty unless they expected meaningfully more than 4.4%? They wouldn't, and they don't. The extra return that stocks need to offer above the risk-free rate to attract capital has a formal name, the equity risk premium. Historically, it's run somewhere between 3 and 5 percentage points above whatever the 10-year is yielding, which means in a 4.4% yield environment, stocks broadly need to deliver in the range of 7.5 to 9.5% annually to justify their existence in professional portfolios. Now, think about what happens when that 4.4% changes. I want to walk you through 2022 step by step, because 2022 confused a lot of investors who thought they were doing everything right. Back in 2021, the 10-year Treasury yield was sitting at roughly 1.5%. That is historically very low. The Federal Reserve had pushed rates to near zero following the COVID disruption, trying to keep the economy from collapsing. In a 1.5% yield world, the math on stock valuations completely changes. If you can only earn 1.5% lending money to the U.S. government, then stocks look attractive even at relatively high price. You only need the stock market to beat 1.5% plus your equity risk premium to justify owning equity. The bar is low, so money flooded into stocks. Price-to-earnings ratios expanded dramatically. The S&P 500's PE ratio reached heights not seen since the dot-com era. Was that irrational? Not entirely. In a near-zero rate environment where the alternative is 1.5% for a decade, paying up for stocks makes a certain kind of mathematical sense. Then, 2022, the Federal Reserve hiked interest rates 11 times over the course of one calendar year. The federal funds rate went from essentially zero to over 4.5% by December. The 10-year Treasury yield moved from about 1.5% to above 4%. This was the most aggressive rate hiking cycle in roughly 4 decades. What happened to stock prices? The S&P 500 fell about 18% that year. Growth stocks, technology, unprofitable companies, anything priced on future potential rather than current earnings, got absolutely hammered. The Nasdaq fell over 30%. Real estate investment trusts dropped sharply. International holdings fell. Almost every major asset class outside of energy moved downward, often simultaneously, and investors were baffled. The companies they owned weren't going bankrupt. Revenue was still growing at many firms. The economy hadn't entered a recession. Why was everything falling at the same time? As if someone had flipped a switch. Someone had. The voltage in the electrical grid shifted. Here's the arithmetic, because this isn't sentiment, it's math. When the risk-free rate moves from 1.5% to 4.5% in 12 months, every other asset in the financial system needs to reprice to remain competitive. If a stock was priced to deliver, say, a 6% expected return in a 1.5% rate world, offering 4.5 percentage points above the risk-free rate, that same stock now needs to deliver somewhere around 9 or 10% to maintain the same appeal in a 4.5% rate world. How does a stock's expected return change? Its price drops. Lower prices mean future returns relative to the company's actual earnings. The repricing isn't a panic. It isn't irrational. It is the fundamental adjustment mechanism of the entire financial system working exactly as it's supposed to. The bond market changed the rules, and every other asset class recalculated accordingly. None of this required you to own a single bond for it to materially affect your portfolio. The voltage changed. Everything plugged in responded. The investors who understood this weren't surprised in 2022. They'd been watching the 10-year yield climb. They'd seen the Federal Reserve signaling tighter policy for months before it began. The signal was there, in public, on government websites, continuously updated. The people who got blindsided were watching the stock ticker and wondering why their quality companies were falling on no particular news. I'm about to tell you about something that is available for free on a government website updated every single business day that the largest and most sophisticated financial institutions in the world spend enormous resources trying to interpret faster and more accurately than their competitor. It's called the yield curve. Here's how it works. The US government borrows money at different maturities simultaneously. It issues treasury bills with maturities of a few weeks to a year, treasury notes out 10 years, treasury bonds at 20 and 30 years. Each of these instruments trades independently, and each has its own yield determined by market force. Under normal economic conditions, the yield curve slopes upward. You earn more for lending money for 30 years than for 3 months because you're taking more time-based uncertainty, more inflation, more duration risk. That's the base. Long rates above short rate, upward slope. But sometimes, and this is the critical part, that relationship inverts. Short-term rates climb above long-term rate. 3-month treasury bills yield more than 10-year treasury note. That inversion is, historically, one of the most reliable forward-looking economic signals we have. Why does inversion matter? Think about what it means at the institutional level. When large, sophisticated investors, the pension funds managing your parents' retirement, the sovereign wealth funds of entire nations, when these institutions get genuinely concerned about the near-term economic outlook, they do something predictable. They park capital in long-term government bonds. Not because it's a great turn, but because in a deteriorating economy, safety and certainty matter more than yield maximization. That surge of institutional capital into long-term bonds drives long-term bond prices up. And because bond prices and yields move inversely, when prices go up, yields come down. Long-term yields fall. Meanwhile, the Federal Reserve may still be keeping short-term rates elevated to fight inflation. So short-term yields stay high while long-term yields fall. The result? Inversion. Short above long. The curve flips. Now, here's the historical record, and I want to be honest about this because some people overstate it. Every U.S. recession since the late 1960s has been preceded by a yield curve inversion. 8 recessions, 8 inversions before them. The New York Federal Reserve tracks this signal and publishes recession probability estimates based on it monthly for free on their public website. However, and this is equally important, the yield curve's most recent notable inversion, which began in 2022, did not produce a recession by the traditional definition as of the time of this video. The economy proved more resilient than many expected for a cluster of specific reasons. Many homeowners had locked in mortgage rates near 3% before the hikes, so they weren't immediately affected. Large corporations had secured cheap long-term financing before rates moved. Consumer spending stayed stronger than most models predicted. So what do you do with a tool that's historically reliable but produced an ambiguous result recently? You treat it like what it is, a signal, not a certainty, a warning system worth watching, not a trigger that requires immediate drastic action. The CAIA, the Chartered Alternative Investment Association, published analysis noting that while yield curve inversions have preceded every recession in the modern era, the lead time is wildly variable. It could be 6 months, it could be 30 months. You cannot use it it as a precise timer. What you can use it for is calibration. When the curve is inverted or recently uninverted, you're in a risk-elevated environment. You might hold slightly more cash. You might be more selective about adding new equity positions at high valuations. You might reduce leverage, not because a recession is guaranteed, but because the cost of being more cautious in that environment is low, and the cost of being caught off guard if things do deteriorate is high. That's rational risk management, not market timing. The yield curve spread, the 10-year Treasury yield minus the 2-year Treasury yield, is available on FRED, the Federal Reserve Economic Data Platform. Free account, updated daily, every single historical data point going back decades. The professional trading desks have millisecond access to this data and quantitative models worth millions of dollars built around it. You have a free web browser and 5 minutes a week. Here's where this gets very specific to your actual financial life, and I don't want to gloss over it. The United States federal government currently carries roughly $36 to $37 trillion in outstanding debt. It runs a deficit, spending more than it takes in, of somewhere in the range of $1.5 to $2 trillion per year. And here's the number that should make you sit up. The Congressional Budget Office has projected that annual interest payments on the national debt will exceed $1 trillion, more than the entire defense budget, more than Medicare, just interest. Why does this matter for your portfolio? Because government debt is funded through bond issuance. Every dollar of deficit spending becomes a new bond that the Treasury needs to sell into the market. More supply of bonds, holding demand constant, means the government needs to offer higher yields to attract buyers. Higher yields ripple through the entire rate environment. But there's a second pressure point. Roughly a third of existing Treasury debt is short-term. It matures within a few years and needs to be refinanced. When that debt was issued in a near-zero rate environment, the interest cost was trivial. When it rolls over now into a 4 to 4.5% environment, the carrying cost of that same debt jumps dramatically. This creates what economists call a fiscal feedback loop. High debt requires more borrowing to service. More borrowing at high rates pushes yields higher. Higher yields make the next round of refinancing even more expensive. The loop feeds itself. Now, what does this mean for your specific retirement projection? Here's a concrete illustration. Say you're 42 years old with $280,000 in retirement accounts and you contribute $1,000 a month. You want to retire at 65. That's a 23-year runway. In 2021, when 10-year Treasury yields were near 1.5%, expected returns on a classic 60-40 stock bond portfolio were genuinely in the range of 7 to 8% annually. Run $280,000 plus $1,000 a month for 23 years at 7.5% annual return. You arrive at roughly $1.6 to $1.7 million, a solid outcome. Now, update the inputs for the current environment. With 10-year yields around 4.4%, your bond allocation actually earns a real return for the first time in about 15 years. Bonds are no longer a drag, but your equity allocation faces compression pressure. U.S. equities carry valuations that are historically elevated. For those valuations to generate future returns, companies need to deliver actual earnings growth, not the multiple expansion that drove gains through the low-rate era. Many serious institutional investors and research houses are now projecting expected returns on a 60-40 portfolio in the current environment at closer to 5 to 6% annually. Run the same scenario at 5.5% instead of 7.5% for 23 years. You end up around $1.2 million instead of $1.7 million. That gap, roughly $500,000, was not created by bad stock picks. It was not created by paying too much in fees, though that matters too. It was created by using a return assumption calibrated to an interest rate environment that no longer exists. The practical consequence is if your retirement plan was built or last updated before 2022, the expected return assumption baked into it may be significantly too optimistic for the current rate environment. And the further you are from retirement, the more time you have to close that gap through higher contributions, adjusted expectations, or both. But you cannot close a gap you don't know exists. This is not cause for panic. It's cause for honesty. Here's the other side of the same coin, the one that actually represents an opportunity most people are sleeping on. The same yield environment that puts pressure on long-duration equity valuations is simultaneously offering you something you genuinely haven't had access to in nearly 2 decades: a legitimate, risk-free return on cash. Short-term treasury bills in early 2026 yield in the range of 4 to 4.5%. They carry no credit risk, they have essentially no volatility, and interest income from U.S. Treasuries is exempt from state and local taxes, which for anyone living in California, New York, New Jersey, or other high-tax states meaningfully improves the after-tax return compared to a bank savings account or corporate bond paying the same nominal rate. On $100,000 sitting in a low-yield savings account instead of treasury bills, you are leaving approximately $3,500 to $4,000 per year on the table. That's money you're effectively transferring to your bank in exchange for the convenience of not spending 15 minutes setting up a brokerage account. Compounded over 8 years, the difference between lazy cash and a short-term treasury ladder on that same $100,000 is over $40,000. That's not a rounding error. That's a car. That's a year of retirement spending. I want to give you something actionable before we wrap up. Not read more books about bonds or hire an advisor. Something you can do this week in under 10 minutes that will give you more macro awareness than the vast majority of retail investors. 3 numbers. That's it. Number 1, the 10-year U.S. Treasury yield. Right now, in early 2026, it's around 4.4%. You can find it on treasury.gov under daily Treasury par yield curve rates. Bookmark that. This number tells you the voltage in the electrical grid. It tells you what the risk-free return is for capital in this economy right now. Everything else in your portfolio competes against it. Above 4%, equities are under real competitive pressure. High valuations need genuine earnings growth to justify themselves. Be appropriately skeptical of return assumptions above 7%. Below 2% rapidly, institutional money is fleeing to safety. That tends to happen before problems become visible in equity prices, not the time to add risk. Climbing fast toward 5 or 6%, financial conditions are genuinely tightening. Something usually breaks. Watch credit market. Number 2, the 2-year versus 10-year spread, the yield curve slope. Subtract the 2-year Treasury yield from the 10-year. If the result is negative, the curve is inverted. This is available on FRED, the Federal Reserve Economic Data Platform, run by the St. Louis Fed, for free, with daily updates and decades of history. The current yield curve, as of early 2026, has largely returned to a normal upward slope after the historic inversion of 2022 to 2024. That's actually a positive development, but recent events, including new tariff policies and fiscal uncertainty, have shown that conditions can shift quickly. Check this number month. When it inverts, don't panic, but do recalibrate. Reduce unnecessary leverage, hold a bit more cash or short-term treasuries than usual. Make sure your near-term financial plans don't require equity-level returns in a stress scenario. Number 3, the high-yield credit spread. This one is a bit more advanced, but worth adding to your monthly check. The high-yield spread is the extra interest that companies with below investment-grade credit ratings have to pay compared to treasury bonds of similar duration. When that spread widens dramatically, when low-rated companies suddenly have to offer much to attract lenders, it signals that credit markets are pricing in rising default risk. Credit markets typically reprice stress before equity markets do. Widening high-yield spreads have historically shown up as an early warning signal in fixed income before the deterioration shows up in stock price. You can track this through the St. Louis Fed's FRED platform, searching for ICE BOA US High Yield Index Option Adjusted Spread. 10 minutes a month, 3 numbers. That is the minimum viable instrument panel for any investor who wants to stop being surprised by macro moves. Here's the broader point I want to leave you with. The financial media ecosystem, the daily stock commentary, the earnings analysis, the CEO interviews, it's built around compelling stories. Companies have characters, products you can touch, narratives you can follow. That makes it engaging to watch. Bonds Bonds don't have characters. Yields don't have stories. A 25 basis point move in the 10-year yield will do more to your actual net worth compounded over time than 90% of the individual stock stories you'll consume this year. The electrical grid doesn't make headlines until the power goes, but it was running your whole financial life the entire time. You now know it exists. You know the 3 numbers to watch. You know what to do when each of them moves. The bond market has been making decisions about your financial future without your input for your entire investing life. Starting this week, it doesn't have to. Go to treasury.gov, find the yield curve page, write down the 10-year yield, write down the 2-year, calculate the spread. That's it, 10 minutes. That's where this starts. And if you want to go deeper, if you want to understand how professional investors actually use this information to make portfolio decisions, subscribe, because this is the kind of content that tends to not appear anywhere someone is also making money managing your portfolio. Leave a comment below with where the 10-year yield is when you're watching. Let's see how much it's moved.